Welcome to Breaking News to Trading Moves. Imagine you're in high school, right? And you get an A plus in calculus, but you fail English, you fail history, and you fail biology.
Yeah, that is a pretty rough semester.
Right. I mean, your GPA might look somewhat acceptable on paper if that math grade is weighted heavily enough. But underneath that final number, you are severely struggling as a student.
Exactly. The top line grade is masking the actual problem.
Exactly. And well, this week, Wall Street's largest banks are basically handing in their quarterly report cards. We have Goldman Sachs kicking off the week, followed rapidly by JPMorgan, Citigroup, Wells Fargo, Morgan Stanley, and Bank of America.
It is a packed schedule for sure.
It really is. And right now, the market is terrified that a massive A plus in trading revenue is hiding some very ugly Fs in the real economy.
Yeah, and that anxiety is exactly what we are measuring right now.
Yeah.
Because when these financial institutions open their books, they give us the most precise look at the mechanics of the economy. But we cannot just look at the top-line earnings beat. We have to examine where capital is flowing, where it is stalling out, and whether strong trading and investment banking results can genuinely outweigh worries about consumer credit quality and guidance for the coming year.
So our mission today is to focus strictly on this headline event and identify the clear winners and losers. We're going to look closely at the mechanical details, so if you have money in the financial sector, you know exactly what metrics to watch.
Absolutely.
Let's start with the heavyweights, the money center banks. These are the large, diversified institutions that investors invariably look at first.
Yeah, they set the tone.
They really do.
Yeah.
So when we talk about conditions for a win here, we're looking for solid trading revenue, stable net interest income, resilient consumer balances, and manageable loan losses. Actually, let's break down that net interest income part real quick, because it is essentially the engine of a traditional bank.
Sure. So net interest income is simply the difference between what a bank pays depositors and what it earns from loans. Like, if you have a savings account, they might pay you 4%. Then they take your money and lend it out for a mortgage at 7%.
So they just pocket the difference.
Right. That 3% difference is their net interest income. And right now, investors are, hyper-focused on whether these money center banks are being forced to pay you more to keep your deposits from leaving, which obviously compresses that profit margin.
Gotcha. So looking at the names, JPMorgan Chase ticker JPM is widely considered the sector quality benchmark for managing that exact margin.
Yes, the gold standard for a lot of investors.
But we also have Citigroup ticker C standing out recently because analysts have highlighted their improving returns. Plus, we've got Bank of America ticker BAC in the mix. Now, I got to challenge the standard logic here for a second.
Okay, go for it.
If JPM is the ultimate benchmark for the sector, does a miss from them drag everyone's sentiment down automatically? I mean, why wouldn't investors just look at Citigroup's improving returns on their own merit?
Well, the sentiment transfer happens almost instantly, but you have to understand the specific type of miss.
What do you mean?
If JPMorgan ticker JPM reports lower earnings because loan defaults are spiking across the board, the market assumes that if the best-in-class operator cannot collect from consumers, well, nobody else can either.
Oh, wow. So it's an industry-wide red flag.
Exactly. However, Citigroup ticker C presents a very different mechanical setup. They have been undergoing an extensive restructuring process, shedding international retail units to focus on core corporate services.
So they're playing a different game entirely.
Yeah, exactly. If Citigroup posts improving returns, it is often a reflection of their own internal cost-cutting and structural improvements. It's micro-execution rather than macroeconomic strength.
Right. That makes a lot of sense.
So while a miss from JPM might create initial downward selling pressure across the board, capital will quickly rotate back into Citigroup if the mechanics of their turnaround story remain intact. Investors will separate the internal execution from the external headwinds.
It is the difference between the weather outside and how well you built your house.
That's a perfect way to put it.
Now, since trading revenue is such a vital performance metric to mask any loan issues for those money center banks, let's pivot to the firms where trading and deal-making are the main events. I am talking about the capital markets and investment banking names.
Deal makers.
Right. The direct read-through names here are Goldman Sachs ticker GS and Morgan Stanley ticker MS. We also have Charles Schwab ticker SCHW.
Yeah, these are the institutions that thrive on velocity. For these firms to register a clear win, Their earnings commentary really needs to confirm robust underwriting and high market activity
Right.
because they have meaningful exposure to wealth management and trading desks, which act as a massive buffer against traditional loan risk.
I always compare these capital markets names to real estate brokers in a busy housing market.
Ooh, I like that analogy.
Yeah, like if you are a real estate broker, you do not necessarily need housing prices to climb to the moon. You just need transaction volume.
Right, you just need the volume.
If clients are actively buying and selling, you collect your commission regardless of the broader economic weather.
That is a very apt comparison. Take underwriting mechanics as an example. When two massive corporations decide to merge, they need an investment bank to underwrite the deal, structure the debt, and facilitate the transaction.
And they pay a premium for that.
Substantial fees. Goldman Sachs, ticker GS, and Morgan Stanley, ticker MS, collect massive advisory fees for making those deals happen. So as long as corporate boards feel confident enough to execute mergers, those transaction fees pour in.
And what about Charles Schwab, ticker SCHW? How do the mechanics work there?
Schwab's business model relies heavily on asset flows and managing cash spreads.
Okay.
If you have $10,000 sitting in your Schwab brokerage cash sweep, they do not just leave it in a digital vault. They invest it in higher-yielding, safe government assets. The difference between what they earn on those safe assets and the minimal amount they pay you on uninvested cash is the spread. When everyday investors are actively trading options, buying equities, or moving cash into wealth management accounts, Schwab collects the execution fees and maximizes that cash spread.
So transaction volume and cash sitting on the sidelines are their lifeblood.
Exactly.
But, there is a very clear causal link from these big players to the rest of the market. If those big money center banks and deal makers signal confidence in credit and corporate action, that confidence acts as a massive tailwind for the regional banks.
Yeah, regional lenders trade almost purely on read-through sentiment from the majors. The names we are tracking in this space include Fifth Third Bancorp ticker, FITB PNC Financial Services ticker PNC, and U.S. Bancorp ticker USB.
Okay.
These regionals have been waiting for what we call a cleaner sector setup.
Wait, explain the mechanics of a cleaner sector setup. Like, if I'm an investor holding regional bank stocks, why have I been dealing with so much anxiety lately?
Well, because over the last couple of years, regional banks have faced intense scrutiny regarding their commercial real estate exposure.
Ah, right. Office buildings and stuff.
Exactly. Investors have demanded a much higher risk premium to hold a regional bank stock because they fear a sudden liquidity crunch if a local office building defaults on its loan.
Makes sense.
But the major banks act as the scout team for the entire financial sector. When a giant like Bank of America, ticker BAC, reports that their commercial clients are completely healthy and their deposit base is perfectly stable, they are telling the market that the terrain ahead is safe.
And once the scout team says the terrain is safe, that risk premium on the regional banks just evaporates.
Exactly. Fifth Third Bancorp, ticker FITB, and PNC Financial Services, ticker PNC, rely heavily on traditional loan demand from mid-sized businesses. So if the big banks confirm that corporate loan demand is accelerating and there's no need to hoard capital reserves for future defaults, investors will immediately buy into these regionals, anticipating higher profit margins without the looming threat of commercial real estate collapsing.
But there is a dark side to this big bank safety net.
Always is.
While a positive report lifts the regionals, a cautious tone from executives about the economy puts a harsh, blinding spotlight on lenders exposed to credit risk. And that brings us to the vulnerable lenders, specifically private credit vehicles.
Right, the pure credit plays.
Yeah. The names under pressure here are Blackstone Secured Lending Fund ticker BXSL Heirs, Capital ticker ARCC, and Oaktree Specialty Lending ticker OCSL.
This is an area where investors often get trapped by misunderstanding the mechanics. If bank executives sound even slightly cautious on the broader economy, capital will swiftly rotate away from these private credit lenders.
I gotta challenge this logic, though. Let's say JPMorgan posts an objectively phenomenal quarter. They beat on revenue, they beat on profit, and they prove that lending is still generating cash.
Okay.
If the biggest bank just proved the borrowers are still paying, why would it be rational for investors to dump private credit vehicles? It seems entirely contradictory.
It looks contradictory until you examine the specific types of borrowers involved.
Yeah.
This is where your high school report card analogy really matters.
Okay, tell me more.
JPMorgan could post a great final grade because their trading desk had a record quarter and their investment banking fees skyrocketed. But during their earnings call, the CEO might casually mention, "We are tightening our lending standards for middle market corporate borrowers because we see some strain.
Ah. So the big bank survives the credit weakness because they have those highly profitable trading divisions masking the pain.
Correct. But private credit vehicles like Ares Capital, ticker ARCC, and Blackstone Secured Lending Fund, ticker BXSL, are pure play lenders. They do not have a global trading desk.
Right, no buffer.
Yeah, exactly, no buffer. Their entire business model is extending credit strictly to middle market companies, frequently using floating rate debt.
Which means as interest rates stay elevated, the interest payments those middle market companies have to make go up, putting them under extreme pressure.
Yes. Think of private credit like a specialized boutique store, while JPMorgan is a massive department store.
Okay, I like that.
If foot traffic drops because the macroeconomy weakens, the department store can slash prices in the electronics section to survive because clothing and appliances are still selling. The boutique only sells one thing. They have no other departments to fall back on.
Wow, right.
If middle market companies struggle to make their floating rate interest payments, these private credit funds absorb the direct, unfiltered impact.
And the market is smart enough to know this. As soon as cautious guidance on middle market borrower health is uttered on a big bank earnings call, the market instantly prices in higher default rates for firms like Oaktree Specialty Lending, ticker OCSL. They do not even wait for a loan to go bad. The capital just leaves based purely on the macro environment outlined by the heavyweights.
It is an immediate mechanical reaction. The heavyweights dictate the weather, and the pure play lenders have to stand out in the rain.
But private credit isn't the only group pressured by the big banks. Sometimes the heavyweights simply set the performance bar entirely too high for their smaller peers to compete.
Yeah, that happens a lot.
This brings us to the smaller, domestically focused banks, which often find themselves penalized when the majors overperform.
This comes down to relative valuation. Big bank earnings can dramatically raise the expectations for the rest of the sector. The names you want to watch in this dynamic are KeyCorp ticker, KEY Citizens Financial Group ticker, CFG and Zions, Bain Corporation ticker, ZION.
It feels exactly like presenting your project at a local science fair, right after a team with a university-funded lab just demonstrated cold fusion.
That's hilarious.
I mean, the heavyweights raise the standard so high that smaller domestic banks suffer simply by comparison, even if their own projects were perfectly functional.
That captures the institutional investor psychology perfectly. If you are a portfolio manager, you have a fixed amount of capital allocated to the financial sector.
Okay.
If a major money center bank proves they have a fortress balance sheet, robust global trading revenues, and zero issues with credit costs, you are going to buy their stock.
Right.
Why take on additional risk with a smaller domestic bank if the biggest player is offering safety, yield, and growth?
So look at a smaller bank like Citizens Financial Group, ticker CFG. They are highly concentrated domestically. They do not have massive global wealth management divisions smoothing out their earnings.
Right.
If they post a politically adequate quarter, is adequate no longer good enough?
Adequate is punished in that scenario. If the majors set a flawless standard, any cautious tone from smaller names regarding sluggish loan growth or regional credit costs causes institutional money to rotate out.
So they just dump the smaller names.
Exactly. Investors will simply sell the smaller bank stock, like KeyCorp, ticker KEY, and move the capital to the heavyweight. The smaller banks are structurally disadvantaged when the biggest players dominate across all business lines simultaneously.
And this rotation of capital based on balance sheet comparison leads us to our final evaluation. When investors are scrutinizing balance sheets and earnings visibility, they aren't just comparing small banks to big banks.
Nope, they're looking across the whole landscape.
Right. They are comparing new financial technology to traditional finance. This is the flight to traditional safety. The names caught in this crossfire include SoFi Technologies, ticker SOFI, PayPal ticker PYPL, and Affirm ticker AFRM.
Yeah, the fintech space is constantly battling traditional banks for market share. Historically, a company like PayPal, ticker PYPL, or Affirm, ticker AFRM, traded at a much higher valuation multiple than a traditional bank.
Because of the tech label.
Exactly. Investors paid that premium because they believed these tech platforms could capture payment volumes and consumer finance margins faster and more efficiently than a legacy bank. They were priced for aggressive growth and total disruption.
But let's look into the mechanics of why that capital suddenly flees fintech platforms when legacy banks post strong numbers. I mean, why does a good quarter from a legacy bank physically drain capital from SoFi Technologies, ticker SOFI?
It all comes down to the cost of acquiring and keeping deposits. Legacy banks have an immense structural advantage sticky, zero-interest checking accounts.
Oh, that makes sense.
Think about your own checking account for a second. You might have had the exact same account at a traditional bank for 15 years, earning 0.01% interest, and you never move it because it is tied to your direct deposit and your bills.
Yeah, it's just a hassle to move it.
Exactly. And that is virtually free capital for the traditional bank.
Wow. And the fintech platforms do not have that luxury.
They really don't.
Yeah.
To attract your money, a newer platform like SoFi Technologies, ticker SOFI, often has to offer you a 4 or 5% yield on a savings account. That incredibly high customer acquisition cost crushes their margins compared to a legacy bank.
So when the investor looks at the fintech trading at a massive premium and then looks at the traditional bank trading at a discount, they realize the traditional bank is doing the exact same digital payment tasks just as well, but with a fortress balance sheet and basically free deposit capital behind it.
That is the exact mechanical trigger. If traditional banks report earnings and prove that their internal digital payment systems are thriving and they are acquiring new consumer accounts while keeping deposits sticky, the entire narrative of fintech disruption loses its momentum.
Capital just flows right back out.
Capital flows directly out of the high-valuation tech names and back into the safety and steady dividends of the traditional barking giants. The earnings visibility of a bank with a 100-year track record simply outshines the growth promises of a newer platform when the macro environment demands reliability.
It is a brutal reality check. The tech platforms have to prove they can completely out-innovate the legacy institutions, while the legacy institutions just have to prove they are competent enough to hold their ground and upgrade their apps.
Pretty much.
Well, we have covered a massive amount of ground today, looking at every angle of this earnings season, from the major money center heavyweights proving their net interest margins, to the deal makers collecting their transaction fees, to the vulnerable pure play private credit lenders and the pressured fintech platforms.
We really have. We evaluated exactly how capital moves through the financial ecosystem based on the specific metrics these institutions are about to report. Whether it is a cleaner setup lifting regional banks or cautious guidance stranding middle-market lenders, the mechanics of these earnings will dictate portfolio positioning for months to come.
As we wrap up, I want to leave you with a final thought to ponder. If traditional banks show such remarkable strength in digital payments and consumer finance that they can successfully draw investment away from nimble fintechs, what does the next evolution of a traditional bank look like? Will the dividing line between a legacy financial institution and a pure technology company completely vanish?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you for joining us today. We hope we've successfully connected the dots on this earnings season for you. Keep a close eye on that report card as the numbers roll in, and we will see you next time on Breaking News to Trading Moves.